Hello, Wealth Masters. My name is Greg Phelps, and I am your host to the Wealth Summit. The mission here at the Summit is simple. We want to educate and empower you with actionable tools, tips, and tactics to help you grow, protect, and maximize your personal wealth. Today's guest, Mark Maurer, is going to talk about long-term care insurance, and so we are going to focus today on that protection factor of the mission statement. So, Mark, are you ready to help us master our wealth?
I am ready.
All right, great. So a little bit about Mark. Mark assumed the reins of LLiS, which stands for Low Load Life Insurance, in 2012 after 9 years learning the family business. He's built upon the foundation that Judith, his mother, had built by adding more talented staff members and new technology. He's happily married. His wife, Leah, is an adjunct mathematics professor at the University of Tampa. He also has 2 children. He's got a 9-year-old son, Jay, who's into soccer and any book on sports, and a 7-year-old daughter, Marie, who loves ballet with our own Miss Ashley and art. What most people don't see him do is work out. March at the YMCA at the crack of dawn before the sun is even up, when most people are still sleeping. Mark, today I can tie you because I was up at 4 a.m. and ran 6 miles. So that's so we got something in common just today only.
You win because I slept in today.
Oh no.
And with the time change, you won by like 7 hours or something.
All right, I'm going to chalk that up to just a small victory for me today. Mark, so that's a little bit about your bio. Go ahead, take just a quick second, fill in any gaps that you might want to share with the Wealth Masters.
Sure. No, I'd grown up hearing about insurance, learning about it, but I went away to school. I worked for an international shipping company for a number of years. I worked for a natural gas trader in Gainesville, Florida, and one day sort of had a conversation with Judith about being the succession plan, and I think I'd never really thought about doing it, so I got to experience a lot of different things. It wasn't ever assumed that I'd be here, and I love it. It's been years being here, and it's I really enjoy doing what I do. Every day is like a puzzle, working with financial advisors and who say, my clients have this, here's what I'd like them to have, how do we rework, keep, adjust, change.
Improve.
That's fun for me. Improve, that's fun for me to do every day.
Well, just for the viewers out there, I met Mark through our organization that we both are involved with, which is NAPFA, the National Association of Personal Financial Advisors. Goodness gracious. Actually, I just looked at my original life policy I got from you back in '08. I pulled that up yesterday, which was probably the best investment, even though hopefully it'll never pay off, but
Right.
the best investment that I'll ever have made. So anyways, we're both associated with the National Association of Personal Financial Advisors, which is a group of fee-only fiduciary financial planners. So make sure you remember those terms, fee-only fiduciary, when you're working with a financial advisor. So Mark, let's go ahead and kind of dig right in, because when I approached you to be a speaker at the Wealth Summit, I am not an expert in insurance. I am a CLU, but I am by far from an expert in insurance. And I get these questions from clients, and they come in and they say, hey, you know, what happens if I get sick late in life? So let's just go ahead and start with a very, very foundational level and talk about what exactly is long-term care insurance.
Sure. Long-term, let's take a step back. If we think of health insurance, what does health insurance do? Well, health insurance doesn't prevent us from getting sick. Health insurance is a funding mechanism to pay for things if we do get sick. Long-term care insurance is sort of the same thing. When a long-term care insurance policy would provide benefits is if someone becomes cognitively impaired, they're diagnosed with Alzheimer's, they need hands-on or standby assistance to do activities of daily living, such as toileting, transferring, eating, bathing. So they're all things that at some point in life we may not be able to take care of ourselves as we'd hoped. And the other part about long-term care is, again, unlike medical insurance, that's usually used for prescriptions, doctors, things that are designed to treat and get you better. Long-term care is sort of the name of it gives it away, long. It's for something that's chronic that probably isn't going to get better. And so you have those two different things, health insurance, Medicare for treating specific things, and then long-term care that comes into, or long-term care insurance that comes into effect when I'm not going to necessarily get better from these things. Again, Alzheimer's is something I think that's touched a lot of people through their families, somebody they know, and that's a really good, idea. Hopefully one day we have treatments for Alzheimer's. Hopefully one day we have a cure, a medicine that can, cure it. Today it's all about, once you're diagnosed with it or have that as a concern, then how do we fund for people to care for mom, dad, grandma, grandpa, and where are they going to get that care? And so the long-term care insurance is the funding mechanism or vehicle behind that to be able to provide care.
Okay, and real quickly, and off the slide topic, I guess, if we don't plan for things like long-term care expenses later in life, what happens if there's just no assets there to take care of somebody who needs years of care? What happens?
And that's a good, that's a good question, good point, because if you don't plan, you've decided, that's your default plan is to do nothing. And so then you're relying on usually the government, which people are surprised that Medicare really doesn't cover much for long-term care. Medicare may provide benefits for only up to 100 days. Like I said before, Medicare health insurance is designed for things that get you better and then get you off, claim or benefits. So Medicare usually covers up to 100 days of long-term care. After that, if you really truly have no assets, then Medicaid may be able to cover some of those expenses. One of the problems with Medicaid is that you may not get to pick where you receive care. Most facilities are either Medicaid eligible or may have a few Medicaid eligible rooms or spaces, and if you want to be close to home, you may not have that option with Medicaid. And your other option is family. You say family members may be able to provide that care. There's a lot of people who are living with their children, and the children are their long-term care plan. And again, need to make sure that your long-term, if your children are your long-term care plan, that they know about that, because that may not be what they were planning on.
Right. Okay. So you're really kind of subject to the whims of maybe I get a little bit of coverage from Medicare and then maybe some coverage from Medicaid, but it's completely out of my hands. I could end up at 50 miles away from my family.
Right. Exactly.
Or you end up living with your kids.
Mm-hmm. Yeah. Those are when you haven't planned for something, either by having enough assets, enough income, long-term care insurance, whatever it might be, those tend to be the default or fallback, what happens.
Okay. And with, what do we have, something like 10,000 people turning baby boomer age and, every day, or not baby boomer age, but retiring, 10,000 baby boomers retiring every day. This is an aging population, so it's just a really critical issue.
Right, and it's you're seeing a lot more, to your point of everybody retiring, you're seeing more and more multi-generational households than ever before, because mom and dad were relying mostly on Social Security, and that was going to be how they were going to pay for everything, and the costs of needing care far exceed what a normal income might be, an extra $50,000-$60,000 a year if you need substantial care. And so where does that come from? Whose pockets is that coming from? It can be the government's, could be the kids taking care of mom and dad. And one of the things we also look at with long-term care insurance is a lot of people, one of their primary assets is their home. That may have hundreds of thousands of dollars of equity, but if somebody needed to pay a nursing home, how do you fund that? You may want to leave the house to the kids, and so a long-term care policy. Right, you have to sell it. Most people think that that's a conversation I would never want to have. Most people probably going to a facility don't want to sell the house because they don't want to admit, probably I'm not coming home. Yeah. And so you have this large asset, maybe not a whole lot of spendable assets, and long-term care insurance helps be that I can use this to pay for care, leaving the house that I can pass to the kids.
Well, I can definitely speak anecdotally. I think there's a big peace of mind factor that comes with planning for this up front. I know in our family, and I don't mind sharing personally, my stepdad has later stages Parkinson's, and so we're in the initial stages of kind of figuring out, hey, when do you start looking at using this long-term care money and so forth, and how does that play into the overall picture? So it's a really important discussion to have with your family, your spouse, and people that are close to you. But what I'd like to kind of talk about now, and Mark, just so you know, this slide will stay up for a little bit. I'd like
Okay.
to talk about what exactly are long-term care costs roughly. Now, I know you pulled this quote for Nevada because that's where I'm located, and thank you. And so obviously it's going to vary state by state, but just kind of run
Right.
through some of these things.
Sure. And so we have the slide there, and Genworth does a study every year, and they survey thousands of providers all over the country to get these estimates, and it's usually broken down into I think this is 4 different subsections. So you have your home health care, a long-term care insurance policy. Once you meet those triggers of either having a cognitive impairment or needing help with 2 of those activities of daily living, and you need what they call hands-on or standby assistance to do those, then you're eligible for benefits. And the long-term care policy is usually defined as $3,000 a month. You can use that for different levels of care. And then where you receive the care is up to how significant, let's say, the condition is. So one of the places that you can receive benefits is in your home. And the slide is showing that monthly in Nevada, on average, and I think it was Yogi Berra who said if you put 1 foot in a bucket of boiling water and 1 foot in a bucket of ice water, on average, you're comfortable. So this is, designed to be just a really ballpark number. But it says that around, on average, about $4,000 a month is what somebody can expect for homemaker or home health care services. So this is usually for somebody to come in about 8 hours a day to help care for somebody, whether that is helping them get bathed, probably doing a little bit of helping with meals. That's about $4,000 a month on average extra. So that's not including food. All of your normal living expenses are built in there. That's an additional $48,000 a year if you just need care in the home. There's a second subset that's the adult daycare, and this would be probably for somebody who's living at home or living with their children, and they still need to work. They're probably in their 40s or 50s, mid 50s. They're in their primary income earning years and are caring for mom and dad, but they have to work. They can't be home all day. So there's adult daycare facilities where you basically, it's not unlike child daycare. You take your parents to this facility, they help them, watch them all day, and then you pick them up at the end of the day. And that's quite a bit less because it's a facility. There's usually more home health aid. You figure is one-on-one. The adult daycare can be one provider, one caregiver for multiple people, right. And that's about $1,500 a month. You have your assisted living facility. This is, my growing up in Tampa, our grandparents were in Nebraska, and we moved to Florida when I was in 3rd grade. And across the street, we had neighbors who were grandparent age, and we called them Grandma and Grandpa Demery. And they were like our grandparents. And at some point, my grandpa Demery passed away. My grandma Demery moved into an assisted living facility. She didn't have Alzheimer's, no cognitive impairment, but she was just older and little and frail, and just things were hard. And so she was in an assisted living facility, and the cost of that for a private 1-bedroom, $3,000 a month. And that's not usually considering some things like food, being here in Florida, we have some great assisted living facilities. I can't wait till one day, like I want to move in today. They have a Starbucks in the basement. You can get smoothies anytime you want.
Hair done.
Oh yeah, big screen TVs with movies at night. This is where I'm going. But they don't let me in. So, but those are facilities, and that's about another $3,000 a month for that sort of level of care.
Mm-hmm.
And those are probably, the last study I read, about 70% of people who are receiving long-term care fall into one of those three.
Mm-hmm.
These are the most common. A lot of people don't necessarily move into that last category, the nursing home care, sort of until the later stages.
Mm-hmm.
And you can see the difference, because the homemaker, the assisted living, you're not, people are around, but they're not necessarily doing quite as much. When you move to the nursing home care, now you have nurses who are caring for you, doctors, a lot more significant levels of care, and it's reflected in the costs, $7,900 to $8,600 a month.
Mm.
And usually with those, in those costs are built in some things like food, the fact that you're usually in a nursing home, they're providing your meals.
Mm-hmm.
You're not driving out to McDonald's to get your, Big Macs or anything. They're bringing you food.
They've got to be smuggled in.
Yes. And so, within that, that's sort of all of your living, expenses built into one. But it's almost, twice as much as some of the others, because, at home, you're still paying for your mortgage, you're still paying for your utilities, you're still paying for all your food. Once you move into the nursing home, that's pretty much where all of your expenses are coming from. And so a lot of times,
if one spouse is at home still, you've got this $8,000 a month outflow, and you still got a house to run.
Right. Still have a house to run. Still have, he or she's still has their food. The utility bills are pretty much, the electric bill to cool a house doesn't matter how many people are in it. Although it seems the older you get, the less cool you have to keep the house. So maybe that helps out a little bit. But so those Mark, are sort of the.
I was going to say, so I mean, obviously these are some pretty hefty expenses that we're looking at. I mean, we're talking about anywhere from 50 to 100 grand a year, plus or minus, for these different services. So if you don't, I guess the point that I'm making is, if you don't take these into consideration, this could bankrupt you. I mean, this could wipe you out financially.
Absolutely, and you see the nursing home. We could probably say, okay, adult daycare, an extra $1,500 a month. That's, we can absorb that. $8,600, an extra $8,000 a month. There's not a lot of people who can say, yeah, we can do that for an indefinite period of time, and it won't impact our retirement plans. It won't impact what we might leave as a legacy to our children. And so the danger is not planning. And if you could see we don't have the ability to pay $8,000 a month pretty quickly. You're moving in with your kids, or it's gone. You're at a Medicaid facility that may not be where you want to be.
Right. And Mark, I'm sure you probably have some stats and figures and studies, but what are the odds that I'm going to need, long-term care expenses, whether it's, in-home or skilled? I mean, what are the odds that I'm going to face these expenses?
The odds are that about 2/3 of women and about 1/3 of men are going to need care at some point in time. And recently, a lot of the long-term care insurance companies realized that in some of their pricing. It used to be that males and females paid the same premium. If you were 55, husband and wife paid the exact same premium. And over time, they've realized, and it's not probably earth-shattering information, that women tend to live longer than men. I think we've known that for a long time. And what they realize is that because women are living longer than men, they're more likely to be alone. And even though us men probably are horrible caregivers compared to our wives providing care for us men, that when they were together, the husbands are helping with some of those things. And so you may have somebody who needs a little bit of care, and while the husband's alive, he's just doing it. When he's gone, then she needs care. She starts using a policy for benefits. She starts going into an assisted living facility. And because her life expectancy is longer, I think I read something that 75% or 80% of the residents of nursing homes are women. So recently they've adjusted, the insurance companies, most of them have adjusted so that female rates are higher for the same benefits than men, because they're much more likely to actually use the policy.
Wow. Okay. You know, and it makes a lot of sense the way that you describe it, because they live longer, and because the man typically dies earlier. The husband's going to be there to take care of her until he's gone, and then all of a sudden the wife is on her own.
Right. And then is she moving back in with the kids? Is there a facility? What's that decision tree at that point that they didn't have to make initially if she needed the care first?
Okay. So Mark, this all sounds interesting, and I want to start planning for this. How does the whole long-term care process work?
Well, at least as far as the application process, it's one of the things that we do is we work with a number of different companies to try to find the best fit, and how we find the best fit is talking to the clients, your clients, the people who want to apply for the policy, and we're going to get a pretty detailed health information worksheet done on the clients, because when you apply for the insurance company is going to do what we call underwriting. They're going to look at a client's application. They're going to look at their medical records, prescriptions they may be taking. Some long-term care insurance companies even have what's called a paramed exam, where a nurse comes out and takes a blood and urine sample, gets a height and weight if somebody hasn't seen a doctor in a number of years. And what I think is interesting is that a lot of times we're used to, or at least advisors are used to, the underwriting for life insurance. Oh, they have this. They can't get life insurance, so they can't get long-term care. Actually, many times it's not, it's sort of the opposite. Life insurance is looking at what are the chances of you dying too soon. And so if the farther back somebody says, I think they're much more likely to die than the normal life expectancy, that person might not get eligible for life insurance. The long-term care insurance is looking at the exact opposite. What are the chances of this person living too long, living past normal life expectancy, living past where they're able to care for themselves? So there are things like heart attacks that are much less of an issue for long-term care insurance than it is for life insurance, because a lot of times it's the second or third heart attack, it will kill you.
You're just dead. Yeah.
You're just dead. There's no long-term care claim. Where with long-term care, that's not a concern to them. But something like another good example is MS. For long-term care, it's a non-starter. It's this person is has a diagnosis of something that is almost certainly going to have some limiting effects. For life insurance, many times it's not an issue. May not get the absolute super preferred rates, but a lot of companies will look at a standard rate because that person's life expectancy isn't actually diminished all that much, but the ability to do things is potentially diminished quite a bit. And so you have a life insurance that's normal, long-term care not eligible. So back and forth between the two different things is the underwriting. But a home office underwriter reviews the application, medical records, and then they make an offer. Standard, hopefully, most of the time long-term care is the number of rate classes is pretty small. With life insurance, you have super preferred, standard plus, standard, lots of different options. Long-term care insurance, it's usually you're approved. Some might have a preferred rate and a standard rate, and it's relatively streamlined. And once you're approved, then the policy can be issued, and have to pay the premium, which is the part that people like the least, and then the policy is in place.
Okay. And so once it's in place, and for example, in my family situation, where we're considering, at what point do we actually pull the trigger and start taking some of these benefits? From that process, walk us through, the next few years, and how that works.
Sure, sure. So for a number of years, hopefully nothing happens and you pay the premium. Depending on the design of the policy, there may be some built-in annual increases, and so starting off at a $4,000 a month policy grows a little bit every year. So 10 years down the road, it's grown to $5,000 a month that you could use for long-term care benefits. Something happens and realize that the insured may need to be able to use benefits. So you contact either us, the agent, or the home office directly, and say, my dad, my spouse, my whoever, was recently diagnosed with Alzheimer's, and so we're looking at how are we going to provide care. We have this policy. How do we, start doing this? And you essentially open up a claim, and the insurance company is going to probably contact the doctor, get some of that information, look at the claim. And what's really neat about a long-term care policy is that you have what's called a care coordinator. Mm-hmm. Let's say that I don't, my parents live here in Tampa, actually about 3 blocks that way. So it's easy. I would, if something happened to them, I would have some pretty good resources of where to go. But let's say they live in Arkansas. I have no idea who a good home health care provider might be in Arkansas. Mm-hmm. And the nice thing about working with the long-term care insurance company is, let's say Mutual of Omaha has providers who they've worked with in the past, and they're getting feedback of ABC home healthcare was great, XYZ home healthcare not so great. So you have these care coordinators or people who they've worked with, have alliances with, to say, here's some good healthcare, home healthcare providers, and you have that care coordinator where even if you're far away, you can, kids or a spouse can help manage some of that as well.
So let's just say that we start off with home health care. And we've got somebody coming in to help out and do some of the, cooking or whatever that may be for 8 hours a day or whatever that number is. Right. At what point do you have to refile a new claim to graduate into skilled care or something like that? How does that work?
Good question. Good question. No, once you qualify for needing benefits, you don't ever have to qualify again. People can come off of claim and then go back on, but what happens is once you go on claim, and let's assume again something like Alzheimer's where it just doesn't get better, then every month there's a home health care provider. You're paying the home health care provider the expenses, you're sending the receipts to the insurance company, and they're reimbursing you for either how much you've paid or up to the policy limit. Mm-hmm. So let's say that the policy benefit is $5,000 a month. This month took care of dad, and the home health care bill for everything was $4,500. You pay the $4,500, submit the receipt to, again, Mutual of Omaha. They reimburse for $4,500. Next month, something happened, needed some additional care, and it was $5,500 this month. You pay the $5,500 to the home health care provider, send the receipt to Mutual of Omaha. They'll reimburse $5,000 because that was the maximum monthly benefit for that policy.
Okay.
So and what happens is in that first month, that $4,500, that $500 you didn't use that month stays in your pool, and so it's sort of added on to the end. Sometimes I think that's the long-term care insurance companies didn't do a great job of defining policies by having years of benefits as compared to a pool of money. Mm-hmm. And so if you use less than the monthly benefit each month, it stays in a pool, and so you can get claims longer. You just are limited each month on how much you can use.
I did not know that. There's a lot I don't know about insurance and long-term care, but I did not know that. So, a lot of people, I think, when they come in, they assume that I can only get long-term care for a certain number of years or periods, mm-hmm. I guess, months. And so what you're saying is if you're spending less than the policy max, that could drag out longer than whatever the policy says.
Absolutely. Like I said, we've defined it. I think how we're going far back, however far back, the insurance companies defined it as $5,000 a month for 3 years. I think that's easier for people to understand than whatever 5,000 times 12 times 3 is $180,000 pool. When you think of it as a $180,000 pool that I can get up to $5,000 a month, it makes more sense in your head to say, well, if I'm only using $2,500 a month, this can last for 6 years. But the nomenclature is years, 3 years, 5,000 a month, and so I think that's important, is that anything you don't use in any month sort of gets added onto the tail end.
Okay. And then to kind of circle back real quick, so I do have, let's just say at this point, we have home health care, and in a year, it's really become overwhelming and we need skilled care. Does the home health care aid kind of send that up the chain to get you moved, or how does that work?
No. At that point, that can be a physician, a doc. That's usually a doctor or somebody who's making that call, or it can be a spouse. I'm much larger than my wife, so if it was hard for me to move around, if I can move around by myself and she's watching me, she may be able to care for me for a while. But at some point, if she's trying to pick me up, actually move me around, that's more of a decision of I can't do this anymore. Talking to the doctor is probably going to say then, yes, it makes sense to go to adult daycare. It's usually more of a personal choice, and to the insurance company, they're not a gatekeeper to say, no, we think you can stay home, so that's what we're going to do. There's nothing like that.
And that's kind of what I was wondering, if they were going to push back and make it real difficult.
Nope. And to them, the longer that somebody's maybe able to stay at home, the smaller the claim. So they're going to help with that, but they're definitely not in a position to say, well, you need, right.
Okay. All right. Well, that's good to know. So, tell me, Mark, I mean, you deal with all kinds of people on a daily basis, and you work with advisors who have a broad spectrum of clientele and life situations. Who should actually be worried or considering purchasing long-term care insurance?
I get this question a lot, and so I'm going to sort of define it two different ways. One is financially, and one is personally. Financially, I think people who have maybe a house and maybe $400,000 or $500,000 of assets or less are probably not good candidates. They may be able to have it from an income flow perspective now, but if things change, it's not an inexpensive policy, because, like I said, it's likely that a third of men and I think 2/3 of women are likely to use this. It's not 1 in 1,000 use it. It's likely for people to use it. So the more likely you are to use it, the more it costs when you have a benefit attached. Right. So if your assets are too small,
you can wipe out your assets with the premiums.
Right, exactly, and that's one of the things I look at is it going to change your retirement lifestyle if we add this premium? And if somebody says yes, then they're probably not a good candidate, because some point down the road, if things change, they're going to look at this as unnecessary, probably right at the time when they need it. And so that's those people are probably more likely to be thinking about how we're going to qualify for Medicaid.
Gotcha.
I've heard other things say people with a liquid net worth of $5 million or more, they could self-insure, and I'd argue that they could, but I'd argue why. Those are people who the premiums are affordable, and I'd rather spend pennies to insure dollars than to actually spend my own dollars. So $5 million and over of actual liquid, investable assets, I could argue, they may be able to self-fund or do other things. Maybe use life, if one of their concerns is leaving a legacy to their kids, maybe use life insurance. That's how we're going to pass assets on to our kids, and if we spend up all of our other money, that's just fine.
Gotcha.
And then anybody, so sort of anybody else, anybody in those middles are great candidates, because
So
you
we kind of
have
got a
some
net worth
money.
of 500,000 to, or liquid net worth 500,000 to 5 million. You're saying it's a great candidate?
Yeah, yeah,
The
and
mass
because
affluent.
those are right, and yeah, the mass affluent, all of those are, you know, like you said, if all of a sudden I have an extra $80,000 of expenses that I wasn't planning on, it really moves the needle on things that we're doing for retirement, especially if it happens to be an early onset of Alzheimer's at, let's say age 68. My grandma Trimble, actual blood relative grandma, had Alzheimer's and lived a number of years and needed that hands-on, standby, full care for years. And so that can, you think, well, it's just 2 or 3 years. It depends on what happens. It can be, it doesn't have to be 3 years. So it's that, financially, is that, to me, it's sort of that range. And
Okay.
as far as people wise, I think the time when people really start considering it is early to mid 50s. And there's sort of two magical things about that age. Is one, it's about the time when people start having a family member who experiences it. Somebody has to care for mom or dad. It's hard. Sometimes it's, when you're really young, it's hard to think of your own mortality and hard to get a 26-year-old to buy life insurance sometimes. Yeah. When you're 40, long-term care, that happens to, I'm not that old. But about early to mid 50s, somebody's caring for mom, or your cousin is caring for your aunt, and it becomes a lot more real to you. And early to mid 50s is when we start moving. I think people transition in their minds from financially, and in my working years, I'm less before 50, 55, I'm much more concerned about having enough to get to retirement. I'm much more concerned about building it up. 50 to 55, I think something triggers in your mind. 50 happens to be a nice round number, and you start thinking more about how am I going to spend it in retirement, and the long-term care helps prevent you from spending it down too quickly.
Got it.
So 50 to 55, I think, is when people really start considering it. I can talk about long-term care to 32-year-olds all day long, and it's not real.
Now, just out of curiosity, though, anecdotally, a premium for a married couple, age 62, they waited a little bit too long to get it, is $5,000 a year or something like that?
That sounds about right.
And so if I was 40 years old and went to get this, just for, let's just say, one person,
Right.
I imagine it'd be far less than half of that, because you've got so many more years of me paying in before I'll need it.
Right, and so that's the one thing, is if you do have, the hard part with 30-year-olds is they probably also have child expenses, saving for college, student loan debt, all of these other things competing for all of their disposable income, or hopefully they have a little bit of disposable income. And so yes, if somebody's doing really well with savings, and high income earners possibly, it's another great thing to look at. But usually when we start saying, well, and as you meet with younger clients, we need to add some life insurance because, if something happened to you, who's going to care for the kids? We need to add some disability insurance because if you can't work, none of these financial plans work. That's usually enough to make their palms a little sweaty. They thought they were doing great with their saving everything, and then to add long-term care is usually a non-starter.
That's the death knell to the conversation.
Yep.
All right, Mark. So, as I mentioned, Wealth Masters, we both are affiliated with NAPFA, and I kind of want to tackle this next question of, how do I actually get started with a long-term care policy? We briefly touched on it, but I kind of want a little bit more specific, and, how you work with NAPFA advisors, because I know at the end you recommend that people find this and have this in the context of a plan.
Absolutely, and so that's by working with NAPFA planners, they're looking at a client's financial plan holistically and saying, here's all of the different things we're going to look at. Here are gaps we have. A lot of times what will happen is an advisor, because NAPFA advisors are fee only, they don't do insurance, they'll bring me into the conversation. It can be a phone call, it can be an email introduction, it can be lots of different ways. Some advisors want to see initial premiums up front to share with the clients. Others, are already sort of have an idea of what it might look like, and then, ask the clients to contact us to do the underwriting interview. All of those are good options, but it's something that the advisors have worked with the clients and set up and sort of had some of these conversations. If you needed $80,000 for 3 or 4 years to pay for long-term care, where's that going to come from? Oh, I hadn't thought of it. Well, what if you both need it at the same time? Okay, here's a way we can address that and solve that issue.
Okay. So in the context of an overall financial plan, it's a good discussion to have with your financial advisor, assuming they're comprehensive and a fiduciary. And then as far as a NAPFA fee-only advisor, they might reach out to you and say, hey, Mark, or somebody there, your talented team, hey, Mark, I've got this person over here. They've got an issue. Can you, facilitate executing the long-term care?
Exactly, and we get information about the client, find a policy that A, meets their needs, B, fits their budget. We find out if there's any health concerns. Is one company going to be more likely to offer them a policy than somebody else? And so we do a lot of that behind the scenes, from let's talk about this idea of long-term care insurance planning to here's what an actual policy with premiums and benefits might look like.
Okay. And Mark, as you mentioned that, something just popped into my mind. Here's a little pro tip, Wealth Masters, and I heard Mark say this at a conference not too terribly long ago when he was doing a very good presentation. And just to circle back real quickly, that care coordinator, because we talked about the expenses of long-term care premiums, that care coordinator, what you had mentioned at that conference was a lot of advisors are getting kind of a lower level or a base level long-term care insurance policy specifically just for that care coordinator, right? Right,
and that's part of what I look at with the those different levels of costs. Some clients, some advisors say, I'd like a policy that would cover those nursing home benefits. I want to know that I'm covered for all of that. A lot of advisors' clients realize that their clients do have some assets. They do have Social Security coming in. Some have a pension. It seems like fewer people have pensions than in the past, but I have assets, I have other things, so let's have a policy that maybe doesn't cover the $8,800 a month of needing the skilled care, but let's have a $4,000 a month policy, because that covers the home health care, covers all of the basics, covers a lot of different things. And if I need to go into a skilled facility and it's $8,800 a month, well, I know that $4,000 a month is covered by the long-term care policy. I'm on the hook for that extra for the skilled care, but a lot of people transition from, I can stay at home. I'm thinking of my wife caring for me. Initially, she can help, and then I might be able to stay at home, and then the policy is going to cover all of those benefits. At some point, I might need to go into a skilled facility, but that's usually a shorter period of time, and so that lower amount of benefits has been covering a lot of different things, and then sort of only there at the end where I need the skilled care, it's still covering half of my expenses every month, and then I'm just using my other assets for that additional.
Gotcha.
So like you said, using some smaller amount to say, no matter where I'm receiving care, this is going to pay probably the full amount every month. It just depends how much do I want to self-insure for different levels of care.
Right. And as you mentioned, that skilled care, which is double the 4,000, that's 8,000. At least you've got 4,000 covered under kind of a base level policy, and then well, maybe they need 3 months or a year of skilled care, but at least you're limiting your liability personally.
Right. Whereas if I could stay at home for 2 years before that policy is covering most of what I'd need there.
Okay. All right. So here's a question that I get on a fairly regular basis when we talk about long-term care, and can my premiums go up? Because I've seen clients, and that's happened. I thought they were supposed to stay flat.
Well, and their traditional long-term care policies are what's called guaranteed renewable. So it means that the insurance company can't cancel a policy except for, not paying premiums. But they have the ability to raise rates. And what's happened over time is that long-term care insurance is still the sort of the baby of all insurances out there. We've had life insurance policies for hundreds of years by now. Disability benefits and plans are built in decades and decades. The long-term care insurance originally were just nursing home only plans, only facility, and then they added some of these benefits like assisted living and home health care, not really knowing how people were going to use them or how they were going to build them in. So original policies were built in with a couple different things. One were investment earnings, which we know have come down. Lapse assumptions. They assumed rates like life insurance that a lot of people don't actually hold their policy till death on life insurance. And they thought people were going to switch from different policies back and forth with long-term care. And what you found is that people get older, they're not in as good health, and people are holding on to these policies. Almost, I think it's something like 99% of policies are being held till death. Wow. You get it and you hold on to it. And then the claims, they didn't really know how people were claiming. And so, like I said, here recently, they've looked at some of the claims and said, we need to charge women more than men. Mm-hmm. They didn't know that originally. And so there have been rate increases there. Nobody likes to see those. One of the things that I do, because advisors come to us and say, Mark, my client has a long-term care policy. They got this notice of a rate increase. What should we do? And I did one earlier this week. Client had a long-term care policy, got a notice that her premium was going up 20% from, it was like $1,000 a year to $1,200 a year. That sounds scary. Mm-hmm. But the policy is a number of years old. She's a number of years older. To replace that policy today was going to be about $6,000 a year, because the policy had what's called inflation increases, or these automatic inflation benefits. So she'd started off with a $100 a day, $120 a day. It'd grown to $180 a day automatically because she'd had it that long. Mm-hmm. So she's now, however many years older that was, the policy premium she had was building in those increases. So to start at a much higher benefit today and a much older age, premiums are 3 or 4 times what she's paying. So, that's how I like to frame it, is that yes, it's gone up. However, you can't do it today for that much. So as much as we don't like that increase, it's a deal. It's worth holding on to, and hopefully that's where most people are talking to somebody and saying, wow, when you look at how it compares to something else, it's a fantastic policy. Another nice thing that insurance companies do is that if they're going to have that rate increase, usually they, or everyone that I've seen, gives you a few different options. And they say, okay, the premium is going up from $1,000 to $1,200 a year. To keep your benefits exactly the same, it's going to go up. If you'd like to keep your premiums at the $1,000 a year level, we could bring the benefit down from $180 a month to $160. Mm-hmm. What are some adjustments we can make to keep the premium level the same? So
extending the elimination period or something like that?
Yes, extending the elimination period, maybe reducing the inflation amount, reducing the years of benefits. So all things that I think are very important, because you've had this policy for so long, you're older now, you're more likely to use it now than when you purchased it. So find a way to keep it, even if it's reducing. And in this scenario, the advisor was very happy because the client was just going to pay the extra $200 a year. Mm-hmm. When you see that it's quote unquote worth $6,000 today for a new policy, you say, wow, I'm going to hold on to that.
You'd happily pay it.
Yeah, and some people may say, well, that is going to make a difference. Okay, let's bring it down to a 3% inflation instead of a 5%.
Mm-hmm. Got it. Okay, so premiums can go up, and if they do raise them, they have to raise them for everybody in that class, right?
Right. Yes. So the insurance company goes to the state insurance commission and says, we have these policies that we issued between 1988 and 1990. We have had, we didn't we need to adjust the premiums because we haven't had the lapses we assumed, we haven't had whatever, and the state insurance commission actually has to approve these. They can deny them. The insurance company can, in this case, the insurance company might have asked for a 25% rate increase, and the insurance commissioner said, well, you didn't justify 25%, but 20% is valid. I don't think that happens very often, but usually it's they have to show to the state that it is, in order to keep the policy sound for everything, for everybody, that this is necessary and the state has to approve it. And it's usually done per state, and it's usually done on what they call a block. So all policies issued between 1988 and 1990 in the 0735 policy form. They can't rule out Mark Maurer. They can't rule out Greg Phelps.
So they're not going to pick on you or your mom or your uncle.
No, they can't look at people who have had claims or people who are smokers when they took out the policies. They can't do any of that. It's across the board. Here's people who we may have to raise rates on, and those are traditional long-term care policies. There are other policies, and we call them the hybrid long-term care policies, either an annuity with long-term care benefits or a life insurance policy with long-term care benefits that do have guaranteed premiums, guaranteed benefits. So those policies, because they're built on either a life insurance chassis, you're actually paying for life insurance and long-term care benefits, are going to have higher premiums, but they can build in some of those guarantees, knowing that if I pay my $5,000 a year for 10 years, premiums can't come back, premiums aren't going to be changed. With the annuity, it's a single premium policy, and there's here's what we projected, but a guaranteed numbers. So there are options to add those guarantees, but today not on the traditional long-term care policies. I will say that after looking at what insurance companies have done, the policies that are being issued today are the least likely to have future rate increases than anything before, because we've had a continued low interest rate environment, and insurance companies are pricing that in. They have a lot more claims experience, so they're building in more accurate claims experience. They've also built in those lapse assumptions to where they really are and not what they predicted. So, the earnings have come down, the lapse rate assumptions have come down, the claims experience has gone up and gone to gender pricing. So, today a policy today has a much lower likelihood of claims of having rate increases than anything in the past, just because of where we are in time.
And they've got more data to make these decisions and to price them properly up front.
Right, and every year that goes by, it's growing exponentially, because every year that you add new policies, you're also adding extra years to the policies in force, and so it truly is exponential growth on my claims experience on all of these different policies.
Right. And I suppose, Mark, since the state insurance commissioner has to approve these rate increases, it's not like the insurance company's just going to go out willy-nilly and just try to, jack up everybody's rates. That's a good thing.
No.
And
right.
And they have to go to the state insurance commissioner and say, hey, listen, we've had some adverse events in our pool, and if you don't let us raise our rates, we might not be able to stay in business.
Right, and so from my understanding, there's a lot of times a lot of back and forth. It's not a small thing to go and ask for a rate increase. It's a big deal. There's a lot that you have to justify it, probably 6 ways to Sunday, and there's a lot that goes into it, a lot of justification, like you said, because if you don't have good proof, the state insurance commissioner is definitely not going to let you do it.
Yeah, they'll laugh you right out of the office. So I want to transition, Mark, and just a real quick question. Are my premiums tax deductible? It seems like I'm making these premiums to help make sure I don't go on Medicaid, so the government should give me a benefit or something, right?
Wouldn't that be great? And let me grab some of my forms here, because I'd like to say that I keep all of this in my head, but it's not exactly. So for individuals, and this is probably most people, an individual can deduct a little bit. And first, you have to, first the IRS says you can't deduct the full premium. So the IRS gives a table of how much of your long-term care premiums are actually deductible. So let's say that if your between age 50 and 60, the IRS says that you get to deduct up to $1,530 of your long-term care premium, no matter how much your premium actually was. And in order for you to do that, you also have to have your medical expenses also have to exceed, I think it's 10% of your AGI. So you can't, it's not a standalone thing. That plus all of your other medical expenses, you have to be able to deduct a certain amount of medical expenses. I'm sure you know the words a little bit better than I do, yeah. But so you
got to jump through some hoops, and
right.
It's probably unlikely that you'll get much, if any, of a tax benefit.
Right, yeah, so you still have to have, up to 10% of your AGI for paying for medical expenses, and then if you're 55, you get to add $1,530 to that total number. So if that gets you to 11% of your AGI, you get a deduction of the 1%.
Wealth Masters don't plan on getting a deduction for it because it's highly unlikely that you're going to qualify for a tax break.
And at least at the federal level, a lot of states do have some additional benefits if you're in a state that has state income tax. I'm in Florida, I don't, so I have to admit I don't follow that as much as probably other states. And then we can go to the almost the opposite. And so for anybody who's a business owner of a C corporation, there are some fantastic tax deductions available. So a C corporation can pay the premiums for any employees or any owners. The business gets to deduct it completely. It's not included in the employees as an item on the employee's income. Benefits received are still tax-free. You can pick and choose, so you don't have to, like a lot of group benefits, don't have to offer it to everybody.
Really?
So it's really a win-win. It's one of the few things that's a win-win from every way that I can figure it out. You can even have the benefits be deductible for a husband and wife, even if only one's an employee. And wow. So one of the few times when having I know a lot of people like the S Corp for all the flexibility and everything. It's one of the few times when the C Corp actually gives you a little bit of flexibility.
Well, yeah, because if you don't have to offer it and pay for it for every employee, if you can pick and choose, which to me seems very odd. I'm shocked that that's even legal. And you can still write this off. I mean, that's amazing. That makes it, if you actually have a C Corp and a business, and this is even remotely of interest to you doing this sort of planning, it's well worthwhile to look into. Of course, we're not offering tax advice. Please talk to your CPA.
I don't offer tax advice either, so please talk to your CPA.
So Mark, we're going to kind of to bring it on home here with just a sample case that you've got here, a proposal, sure. and this is going to stay on the screen for quite a bit, and we'll kind of switch through each of these. If you could just kind of hit the highlights, just so we know, hey, if we get a proposal, what are we looking at?
Sure. So this is for a male 58 and female age 57, and so I'm just sort of looking at the benefits from the top to bottom. One of the things we're looking at then is the rate class. So and you have sometimes the preferred rate classes, the select or standard, which in this case the select is sort of the normal, the average, the everybody kind of rate. And then you see in the big box where it says nursing home, assisted living facility, home health care benefits. So this policy is, you can use the benefits for nursing home, assisted living facility, adult daycare, home health care, all of the different options. Some companies still offer a facility only plan, but we don't recommend those. And so this is just showing that this is traditional long-term care insurance policy. The maximum monthly benefit available, $4,000 per month per person. So like I mentioned before, if I use $2,000 a month, I'd get reimbursed for $2,000 a month. And right below it, that's sort of helpful there. Our policy limit, $144,000 / 36 months.
That's that pool of money you were talking about. That
pool. So if the male age 58 used his benefits for $4,000 a month exactly, it's going to use up the $144,000 in 36 months. If he stayed at home and was able to have it be $2,000 a month, he's using the $144,000 by 2,000 instead of 4,000, so it actually lasts 6 years.
Mm-hmm.
Right below it, we have the 100%. That $4,000 is 100% available for assisted living or home health care. This is a neat policy in that it has this cash benefit. And what it says is that in any given month, you can get reimbursed for up to $4,000 a month, or you can choose to, instead of that $4,000 a month, get $1,200 in cash.
Huh.
Now, unlike the reimbursement where if I use 2,000, it stays in the pool, this is saying you're giving up the 4,000 to get the 12. The extra doesn't stay in the pool.
Okay.
But it's saying, let's say your daughter's a nurse. Your daughter lives next door, and she's going to be able to care for mom or dad for a little bit. You have the ability to say, I'd rather, she doesn't work for a home health care facility. I want to have the cash so I can give it to her.
Got
and
it.
so that's a nice option built into there. The elimination period. 90 days is the time between when, and we haven't talked about this yet, but elimination period is a lot like a deductible on any other type of insurance. It's usually defined with other insurance as a dollar amount. This one is defined in a period of time. So if this male, age 58, got diagnosed with Alzheimer's on July 1st, he's not eligible to receive benefits for 90 calendar days after that. So you self-insure the first 90 days. She are paying for the first 90 days of care out of pocket, and then after 90 days, then they're eligible to start receiving benefits for that 36 months or until they use up the $144,000.
Okay.
And then right below it is the inflation protection benefit. This is a really neat component to a long-term care policy in that every year that goes by, the $4,000 a month and that $144,000 pool is being increased by 3% on a compounding factor. And why the 3%? Well, the costs of things long-term care have been increasing somewhere in the 2 to 4% range every year. It's sort of the health,
much higher.
And it was 10 years ago it was much higher, and we usually looked at a 5% inflation option. But I think even though as people are getting older, it's more available, and looking around here, and when I go a little bit south to Sarasota, how many of the assisted living facilities I drive by and how nice they look, it's a lot more available today. Mm-hmm. And so the costs are going up about in that 2 to 4%. So we use the 3% so that $4,000 a month is growing, so that if I need care in 20 years, hopefully it's buying that same basket of goods that the $4,000 today did, covering, it may have grown to $8,000 a month, but that's maybe what that monthly for home health care and all of those other things has grown to. Mm-hmm. So behind the scenes, so the premium isn't going up because of that. That's included in the costs, and that's being added to those monthly benefits every year.
Okay.
There's right below it, optional benefits. There's an asterisk next to partnership qualified. I could probably do another hour on what the partnership is, but to try to make it brief, a lot of states have what's called their partnership program, that if you have a partnership eligible long-term care policy. So let's say our male age 58 goes on claim and uses up his $144,000 of benefits. If he applies to Medicaid, Medicaid says we're going to exclude the first $144,000 from your assets. So you get to keep $144,000 of assets before we start looking at how much money you really do have and how much you need to spend down. Medicaid is really available for people who have spent down pretty much all of their money to sometimes $1,500, $2,000 in total. So in this scenario, if he has $144,000 in the bank, he can apply to Medicaid. They say, you have $144,000 in the bank. However, because you used $144,000 from a partnership qualified long-term care policy, in essence, we're considering that you have zero money.
Got it.
You get to hold on to that 144 because you self-insured and use this. again, Medicaid is a two-prong qualification. They look at income as well as assets. So, like I said, could go on for another 45 minutes. Nobody would want me to, so not going to.
We'll save that for next time.
For a part two, if people are interested.
Okay.
And then scrolling down a little bit farther to the shared care. This is something that I think is really neat for couples. And what the shared care does is it allows those 36 months to be linked. So again, to my average, hot, cold, on average you're comfortable. On average, people use about 3 months or 36 months of benefits from their long-term care policy. But for every couple who use both exactly 36 months, there's a lot more who probably one spouse uses a shorter period of time and one spouse needs a longer period of time. So our male age 58 could use 3 years of benefits, his $144,000, and then be able to start using some of her benefit pool if he still needs care. So he can use her benefits, leave whatever benefits are left over for her.
Or essentially he's got 6 years, and of course she would have nothing, but he's now got 6 years.
Exactly. What's another really neat component for this is that, let's say he never needs care. When he dies, his benefits jump onto her policy, and her premium actually doesn't increase from the what's down there in the below. So she gets to keep just her share of the premiums, but any unused benefits from his policy jumps onto hers. And so when we consider that most women outlive their spouses, may need care longer, it's a really neat thing that I think sometimes that isn't highlighted well enough with the shared care benefit, that I don't know if I'm going to need care, but I am going to die one day. Yeah. And it's much more likely for women to need care. Men are more likely to just keel over and die of a heart attack.
Chances are pretty good one of you is going to need it.
Right. And so in this case, but it's likely that he may predecease her, may use it for a short period of time or not at all. So then she's alone and has all of his unused benefits, and her premiums didn't go up. It's a really neat feature.
Good deal.
And then below there you see the premiums, and that sort of highlights the differences that I mentioned. She's a little bit younger, so in theory her premium should be a little bit smaller than his if they were gender neutral, but he's a little bit older, and his premium is quite a bit less because the likelihood of her going on claim is that much higher than him.
Okay. And so combined, because they are under 60, a little bit younger, like we had used the example of me purchasing an insurance policy for long-term care, their premium's about $3,600.
Right. And what you see right below that is the partner both applying. Insurance companies give pretty sizable discounts when two people apply together. And so you can see that it's actually the $3,600 is actually $1,500 less, because they both got a discount than if they were applying, if they were unrelated, a male 58 and female 57, because the insurance company says, well, because they're together, if somebody needs claim, it's likely that she can help with a claim. If he starts to need care, she may do some of the health care herself and not, need to start the benefits as quickly as somebody who's alone. Or she might be able to provide care for some of the days, and they only need a provider, some other days. So they're looking at as a husband and wife are much less likely to need a claim or to have somebody start a claim as quickly or as significantly as somebody who is just by themselves.
Okay. Mark, real quick before we move on to this next part of the proposal, I guess, I'm just curious, I got to ask the gorilla in the room question. What happens if I go and I buy one of these policies at 56 or 57, 58 with my wife, and 10 years we're not married anymore? What happens to the policy?
The policy stays the same. Now, it comes down to, depending on how amicable the separation was, you may not want her using your benefits if she goes on claim. But usually what happens is you can go to the insurance company. The partner discounts usually stay on. You can take off the shared care rider if desired.
And then split the premium up between the two of you, I guess?
Split the premiums up. Most of the time you keep that partner discount because that's how it was issued.
Got it. Okay. Well, sorry, just the gorilla in the room question in my mind. I'm thinking, what happened? Because I have clients and I've seen crazy things. So let's kind of move on to this next slide here, and what are we looking at?
So here, so this is just for him. And so if you look at the 90-day, sort of in the middle of the page where it says calendar day elimination period, and then it has the 90-day column and the 3-year row. The 1404 is the same as what his share of the premium was going to be on the original page. So 90-day elimination period, 3 years of benefits.
Okay.
And so then this is highlighting how the premiums change if we change for him some of these specific factors.
Mm-hmm.
So as you said, when we get the rate increases, sometimes an option is to extend the elimination period. So they could, if they wanted to, they could say, we have enough money to self-insure for 6 months. Okay, then that reduces their annual premium from $1,404 to $1,369. Not a significant decrease, but a decrease is always a decrease.
Mm-hmm.
And then to go to a 1-year elimination period brings it down again a little bit to $1,334. What I always think is interesting, and it makes sense. You would think that a 5-year, 4-year benefit period should be twice as much as a 2-year benefit period. You would think that a 5-year would be, quite a bit more.
Mm-hmm.
Well, because you have a 2-year, if it's life insurance, there's just one event, you die. Do I get 500,000 or $1 million? That's what it is.
Mm-hmm.
Because the length of claim is an undetermined, and if you imagine everybody that goes on claim needs 1 month by definition.
Mm-hmm. But
a lot more people are going to need 2 years than they are going to actually get the 3 years, and a lot fewer people are going to use all 4 years. So the incremental years are less and less because it's less likely. If you go on claim, you're going to use some benefits initially, but the longer the claim goes, the fewer people you have on claim at the longer years. So adding, 2 year, adding a year from 2 years to 3 years is, a little bit more. It's sort of incrementally more, but not as much as. Right. It's not doubling. 4 years is not doubling 2 years because it's not saying you're going to get paid out for all 4 years.
Right. And the likelihood of you needing it for 2 years is much greater than, the likelihood of needing it for 5 years is probably very slim.
Right. And insurance companies used to have some 10-year benefit periods. They used to have lifetime benefit periods. The lifetime benefit periods just started being too hard to quantify. If you give an actuary anything that has defined parameters, you can price it for insurance companies. But to say the claim is indefinite, you can't do. So how do you price that? If with all the assumptions and how long people go on claim, as long as there's an end date, they can do that. Mm-hmm. So what we've seen is, I think most insurance companies, their maximum benefit period is a 5 or 6 year benefit period. It used to be lifetime benefits. Those are, if someone has one, those are, again, keepers. Hold on to those. But it just became how do you price something that has an indefinite end date? You really can't. You're just guessing.
Got it. And I see towards the bottom the expenses are all essentially the same as they were on that first page. The expenses, the notations for the maximum monthly benefit of $4,000 and assisted living, that's all the same as the first page. And then I suppose the next page is actually just the same thing, but for the wife.
The same thing for her. Exactly. So the nice thing about a long-term care policy is that so this changes the elimination period or the benefit period. If we wanted to change the monthly benefit period and keep everything else the same, it is almost exactly proportional. So if we said for her, we want to do the 90-day elimination period, a 3-year benefit period, but just $2,000 a month, her annual premium is going to be almost exactly half of $22,1316. Usually within pennies of that. So that's a lot of times with the quotes, that part isn't usually an optional page because it's so proportional. We can figure it out with a calculator and a good old don't even need the fancy calculator, just the good old $4 Staples calculator. We could do those.
Yeah, I just bought my both of my sons, a calculator for high school now, and that thing was $100. Each
Oh,
one of them was $100.
was it the big graphing
Yes,
calculator?
it was exactly
Oh,
what it was. He says, "Look, Dad, I can graph stuff." I'm like, "Wow, graph my heart that going like this when I spend $100 for a calculator."
all the things that we need in school, and then at the end of the day, what do you need really in life? You need, that,
Yeah,
divide.
that's crazy. Anyways, so Mark, I mean, the next two pages, and we're going to link this on your speaker page. There's just kind of the inputs that you plugged in to get the proposal, right?
Right.
Is there anything you'd like to touch on those?
No, that this is just all the different, sort of just the behind the scenes software programming that comes with all those inputs. Sort of the same thing next page as well. Nothing really interesting in there.
Okay. Well, Mark, let's kind of bring it home. And what I like to say is, if there's just one or two or three critical things that the wealth masters out there watching need to be cognizant of, they need to be thinking of and planning for, and if there's an action item or a takeaway, what are those main things that you want to share with them?
I think the first one was I'm trying to remember in what order I sent them to you now.
I think it's the disaster, scenario. What if you needed X amount of dollars, $50,000 for long-term care?
Right. Do? Yeah. We're having that conversation, and you as an advisor or everybody listening, thinking in your head, where is that going to come from? What am I going to do if I have a group long-term care policy through work, or I have my own policy? Where is that money going to come from? Do I have $6 million of liquid assets, and I have some life insurance to make sure there's money for my kids, or I don't have kids, or don't particularly like my kids and really care what happens to them. I can't imagine that, but so it's that first question is when you start saying $50,000 to $60,000 per person a year, where is that going to come from? And then part two of that is, okay, that's my first answer. What's my backup plan? If that first answer is long-term care insurance, that's pretty good. We've got that covered. We're covering all those different things. What if my backup plan, my initial plan is, well, we'll probably move in with the kids. Mm-hmm. Okay, what if what's the backup plan to that if they say, they got stationed overseas in Guam, or, maybe, something horrible happens to them and they can't care for you. Mm-hmm. What's your backup plan? Is your backup plan Medicaid? Or maybe, your backup plan was your kids. Those ideas, I think, usually get the conversation started, because as parents, we want to provide for our kids. We want to make sure they're great. One of my goals is, my kids are 7 and 9. I got a long time to worry about this, but, I want to not have them, have to rely on them when I'm older, to let them be able to do whatever they're doing and have that, not have that burden to them. And then
I think there's a dignity thing that goes with it as well. I think
absolutely.
Maintaining your dignity by being able to not having to go across town and with your suitcase and knock on the door at your kid's house.
Right, exactly. And even having a long-term care policy, my kids may be helping with that care coordination. They may be, doing some of that, but they're not doing, not lifting me, out of bed, or disrupting their lives, their income earning years, their primary income earning years, or trying to get kids through college, all of those things to have to do with that. So, how are you going to fund that? What's your backup plan? And then the third thing is, do you have any, we call them sleeping dollars or sleeping money, cash values in an existing annuity that could be transferred to an annuity that provides long-term care benefits too. Existing life insurance policies that have cash values that could be transitioned to a life long-term care hybrid. A lot of people have some whole life policies that they've built up over their working years. It was going to be money there if they had the death benefit in case something happened during their income years. As you're getting closer to retirement, there's some money in there. People say, well, I'd really like to free up these premiums I'm paying. I don't really have as much of a need for life insurance as I did when everybody was in college and I was working. So reallocating the money in that life insurance policy to a policy that still has some life insurance benefits plus long-term care benefits can sort of solve, you know, 2 or 3 things all at once. It can free up those premiums, so my retirement spending numbers go down, or can go up in more fun things, hopefully. You know, then have the death benefit there to pass on to my kids if I don't need it, and have that long-term care benefit if I never need it. Because you know, as someone who's a kid himself, I would much rather have my parents be able to pay for things, or, you know, have some life, than rather than worrying about leaving me something, than vice versa.
Exactly.
And I don't think there's probably any kid out there who would say something different. But, you know, I would rather say, you know, if there's cash values there, and, you know, it could provide $200,000 of long-term care, or, you know, $100,000 death benefit, you know, as a child, that just, you know, that would say, that's a, you know, mom, dad,
The long-term
Greg,
care.
that's a great plan. It's covering 2 different things, because, hey, I love you. I love it when you come visit. Not sure about I want you living with me.
So Mark, real quickly, and that's a whole nother subject that hopefully I can invite you back, and, you know, for the next Wealth Summit we can talk about that. But real quickly, so what you're saying is there are life insurance policies, there are annuity policies out there that do have, I guess, maybe a rider for long-term care benefits, something like that?
Right, and that's touched on the hybrid. Those are the ones that have the guaranteed benefits, and, you know, there's even different flavors of the long-term care. Some you can build to have quite a bit of death benefit, where if you need care, you get something like 2% of the face amount of the policy every month in a check. You know, once you qualify, you just get that steadily. Other plans are designed for a little bit of life, you know, sort of minimal life insurance, but you can build the long-term care benefits to look like a traditional long-term care policy. It's going to have 3, 4, 5 years of benefits. I want the 3% inflation option on the long-term care benefits. So some are life insurance designed, or you know, sort of designed to maximize the life insurance component, but you could use it for long-term care if needed. Others are designed more for the long-term care benefits, but keeping the life insurance component there, so so that that you or somebody else will get some form of benefit out of it.
Right. At least it doesn't feel so empty when you're writing your $3,600 a year premium payment.
Right, exactly. You know that there are cash values there, or I know, you know, if I don't use it, my kids get $100,000. If I need it, then there's $200,000 for long-term care benefits. Either way, somebody's getting something out of the $50,000 I put in.
So I think what we effectively just did, Mark, was we took a very interesting and important topic, and we made it a little bit more complex by throwing in these things at the very last key takeaways. So, like I said, stay tuned, Wealth Masters. We will get Mark back on here. I promise you that.
I think I just booked myself another maybe 2 or 3 episodes after doing all that at the end.
Yeah, I'm gonna have to put you on payroll pretty quick. So I guess I would like to kind of sum up, you know, in my opinion, being an APFA advisor and a fee-only planner, it's very, very important. There's obviously a lot of considerations here, and it's a very, very important topic. I will tell you that I don't think that there's a single NAPFA financial advisor out there that doesn't have the capability and the software to model, for example, what Mark's talking about. What happens if you have $50,000 or $80,000 at age 80, and you need to pay for your long-term care expenses for 1, 2, 3 years? What happens to your wife or your husband? What happens to your financial plan? And we can model these things through various software programs, just so you know how important this really needs to be to you. So I would highly encourage you to reach out to a NAPFA financial advisor. And Mark, you know, at the end of every interview, I always ask our guests, I say, you know, hey, how can our Wealth Masters reach out to you if they want more information? And you were gracious enough to actually send people to a NAPFA advisor, right?
Right, absolutely, and our business was built exclusively by working with fee-only advisors, and it's really great for us because you know, I can talk about insurance. If somebody calls me, I can give them guidelines on a long-term care policy, but you know, just from a quick conversation, I don't have the ability to dive in like you do, Greg, or other NAPFA advisors, to say, here's all the different things they have going on in life. You know, how do we find something that fits? You know more about what their budgets are, their needs are, their goals are, and so we come in only when it fits. You know, there's a saying, you know, to a carpenter, every problem what is it?
When
I
all
lost
you
track.
got's a hammer, everything looks like a nail.
Yeah, everything looks like a nail. So, to an insurance person, a lot of times, an insurance is the answer. And if you call somebody and say, I'm looking for a long-term care policy, they're going to help with that. But it may not be the best fit. And so working with a NAFA advisor, we can find things like, oh, they have this old annuity. Great. Let's repurpose that to an annuity with long-term care benefits, sort of do two different things at the same time. So I would ask people to reach out to a NAFA advisor to get that comprehensive plan. This is it's like filling one chink in the armor, but if there's 4 or 5 other chinks, I don't know it. And so getting a NAFA advisor to look at everything in the big picture is really helpful.
Well, I'm glad that you're a NAPFA resource partner, Mark, and it's been a pleasure to talk with you. Wealth Masters, I always say either you control your money or it will control you. Do the planning, take the time, spend some time hopefully with a qualified fee-only fiduciary advisor. It's real simple to go to napfa.org and actually go in there and Google or hit in their search bar, find an advisor. You can find one that's close to you. And to be honest with you as well, a lot of our guests here on the summit, they are NAPFA advisors. In fact, the overwhelming majority are NAPFA advisors, and they work virtually as well. So just because you might not have somebody in the NAPFA system that's close to you, don't be afraid to reach out to somebody who's a little bit farther away if they can solve your needs through go-to meetings like this and web conferencing. So Mark, thank you so much for your time. I really appreciated the chat.
Sure, no problem, Greg. It was great to do it.
All right, this is Greg Phelps for the Wealth Summit, signing off.